We had a frustrating end to the week with many companies down and quite significantly, and the company under the spotlight today, Alphabet itself, was down nearly 5%. And if we just look year to date, we're talking in the last 3 months, many companies have been down quite significantly, and you can see some of the worst hit ones are those in the Mag 7, with Alphabet down 18%. We're talking about a high quality Mag 7 company that in just the last 3 months has lost nearly 1/5 of its total market cap, and this has sent investors very worried. We are now back into extreme fear, sentiment is very low, and this hasn't been helped by the tariffs that Trump has put in place, which seem to only increase more and more as time does go on, and in fact this is building up to a lot of geopolitical tensions and a very possible start to a global trade war. Now our focus is going to be on Alphabet. We want to understand, is it now too cheap to ignore? Is this one where we should consider adding, and very significantly, or perhaps are there other issues that we need to be concerned about? Just picture this, if you added this company 12 months ago, you would be up only 2%, and if you bought at the beginning of the year, you would be down nearly 20%. Now look, if you've been a longer term shareholder, you would have still massively outperformed the S&P, as we will come to show you, up 470%. We also want to point out it is trading near its 52-week low. Both Seeking Alpha and Wall Street do give this a buy rating, very near the 4.5 that would flip them into a strong buy. They also pay a dividend at 0.5%, and as we're about to show you, a very low forward P at 17.2 in relation to their own 5-year, and in fact the lowest right now in the Mag 7. And this is why we do want to bring it to your attention. In fact, trading at a forward P of 17.2, not only significantly below the 5-year average of 22.3, making it a severe undervaluation signal, but also the lowest forward P it has offered over the last 5 years, and definitely why we are taking a closer look and some serious consideration for the portfolio overall. We then move on to this valuation method, but bear in mind we are going to run it through our own discounted cash flow model towards the end. The blue tunnel here signaling the expected fair price. Nice to note, increasing over time, something we all want to see from companies we're invested in, but there is massive disparity around where it sits now and even the lower end of that fair price. Again, another severe undervaluation signal. Now we'll also point out they have an F on the valuation grade, not one we do essentially agree with, because they're comparing it to the sector at 12.6. In fact, we believe it's a significantly high quality company. It does deserve that premium, as we will show you, but as always we do want to highlight it does trade 37% higher than the overall sector, but as we did just point out, now sitting 32% lower than what they have been trading at over the last 5 years on average, and it is pretty much confirmed no matter what valuation metric you look at today, Alphabet is trading quite significantly, in fact, lower than their own 5-year, but also at a premium to the overall sector, one that, as we said, we do completely agree with. Now, we're also going to dissect this throughout the episode, but at a very high level. In their most recent quarter, revenue was up double-digit 12%. In fact, the search advertising, as we will come on to, is meant to be dying, according to Analyst, up 13% year-on-year, and their fastest growing revenue stream, Google Cloud, up 30% on a year-on-year comparative, the fastest growing against competitors like AWS and Microsoft Azure, and we also get efficiencies to both their gross margin, their operating profit, as well as their bottom line net income. Now we also want to highlight the key reason why this company did fall, in fact, after their earnings at the beginning of February, and there are many reasons why it continues to fall, but this specific one was the fact that their AI investment is significantly higher than what analysts wanted to see. They're planning to invest $75 billion for 2025, and it's actually not the highest out of all the Mag 7. Again, we will come on to highlight this, but one thing that Alphabet is known for is their consistency in outperforming. However, revenue did come in slightly under 96.47. Analysts wanted 96.56. EPS though was a nice beat, 2.15 above 2.13. Now, not something you see every day when looking at companies and their earnings, but Wall Street in particular, for some companies, also like to have metrics for what they forecast for other areas of the company, and these include YouTube advertising revenue, which was a beat, 10.47 above 10.23. Google Cloud, even though, as we'll come on to note, did increase 30% year on year, analysts wanted to see a little bit more at 12.19. They did in fact report 11.96, and we can also see they did in fact come under in terms of the traffic acquisition costs 14.89, analysts wanted higher at 15 billion. Now, as we said, one of the large factors for the drop we got in February was that they did come out and say they are looking to spend 75 billion in investments for artificial intelligence and their strategy, and that in all honesty is the second lowest out of the 4 companies we have here, with Amazon estimated to spend 100 billion in what they noted in their earnings as a once in a lifetime opportunity. But one thing we do want to point out, companies are spending a significant amount, but Alphabet are known for their very high return on investment. We're going to show you this in a short bit when we dissect the underlying financial metrics, but that is a good sign to give you faith that they will be able to offer a very high return for the shareholders. They also do expect growth in terms of the EPS over the next 4 quarters, and in terms of EPS, they have outperformed analyst targets 4 over 4 quarters, that in essence giving us that 100% historical track record. And based on EPS, $9 for the end of the year, they're trading at a forward PE near the 17 mark. If you look to December 2026, they're trading at a forward PE of just above 15. Now remember, as we highlighted, their fastest growing income stream is the cloud, where revenue on a year-on-year basis was up 30% in the most recent quarter, and on average in 2024 sitting around the upper 20s. That is a strong sign that they are looking at other areas where they can continue to increase their top line, not just the search, not just YouTube revenue, which are maybe what people do associate with the company, but they're also expanding, and one way they are doing this is through their acquisition of Wiz Security, which is only going to help them increase their cloud revenue, which is already up, as we said, nearly 30% year on year. And it is always nice to see consistency in the growth. That is what we see specifically in relation to Google Cloud, and they did, worth noting, just turn profitable on this section in 2023. Now bear in mind, global market share, they do sit Google Cloud at 12%, behind Microsoft Azure at 21 and AWS at 30, but they are growing faster than these 2 other competitors, whilst also, just as we saw, a very large acquisition into Wiz Security, which we do believe will help offer a lot more to some of their customers and even their customers from competitors. So we should expect this to increase and maybe move into second and first place over the medium to long term. For comparison, AWS is significantly larger, as we've already highlighted, and has been quite profitable for quite some time, but important to understand they are growing at a much slower rate. We've highlighted just in the most recent quarter, Google Cloud 30%, AWS 19%, and whilst over the full 2024 period, Google Cloud was in the upper 20s, we can notice here for AWS in the upper teens. So Google Cloud does need to start taking advantage of the acquisition they've just had and really propel them into first place, which will make this even more of a monster company. Now, because we continue to hear about how search is dying, you may have even forgotten that they do also have the YouTube income stream, which is from their ads, which 2019, so just a few years ago, did in fact sit at 3 billion. Now we're talking triple that at 9 billion, and also increasing more than Netflix, which we do believe can also show room for improvement, which if you have been kept up to date with some of the news, they are also looking at doing additional tiers of YouTube Premium, so we have no worries that this won't continue to grow at the fairly attractive rate we have seen just over the last few years. And what's even more fascinating than that, in just a few years, streaming in the US in terms of where consumers put their time, it's gone for YouTube at 7.5% December 2022 to in fact just a couple of years later to 11.1%. So not only very nice attractive growth, but in fact it is the #1 streaming platform for consumers in terms of US TV time. But also when you look at Netflix, that did start off in the same position in December 2022, hasn't seen that much growth, and therefore we can see why they are able to really increase those ad revenue, and again something just on top of the other streams that we do believe Google has that can continue to show us that double-digit increase. And there are a few more that maybe have gone under the radar that we do want to bring to your attention today. And finally, advertising, not only YouTube ads but even the Google search, we can see in Q4 sat around 54 billion, significantly high in fact even when you do incorporate Meta and the different applications they have at 47.3. In fact, when you look at Google, you should really include both their search and their YouTube ads, just showing how much advertisers do really depend on the company. Now we'll just move away a little bit from that and talk about institutions and insiders and even super investors. Starting off with institutional ownership at 40%. They sold around 49 billion just over the last year, but they've been buying a significant amount more, nearly twice as much at 85.2, and on top of that in Q4 they bought twice as much, 55 versus 25 billion sold. So very clear to see based on the data data in front that institutions, at least in 2024, have been very bullish on Alphabet, and over the next few days we will get the release of Q1 25 to see whether or not that conclusion does still hold true. Also worth noting, insider ownership sits at around 12%. We have around 105 million worth of shares that have been sold just over the last year, and we also notice in Q1 we get some selling at 16 million. Now, as always, we do show you for full transparency who these insiders are, but we want to make you aware insiders sell for many reasons, personal and financial, with the most recent one, 27th of March, so in fact just a couple of days ago, we get an insider sell around 12,000 shares, netting them $2 million. Again, information is here if you do want to incorporate it into your own investment thesis. The other thing to note, when we do look at super investors, it is interesting to see where they hold a lot of their money, as sometimes we do believe they have a bit more information than us, and their performance also goes on to reflect that. So when we take a look at the most held stocks by super investors, you can see Alphabet is sitting in second place with ownership count sitting at 30. If we look at GOOG, well, essentially it is also the same company, different type of voting rights, sits at 26. So if you were to add the two ownership counts together, we can already see that Alphabet is the number one stock held by super investors. Now, if we move away from just the number of super investors that hold the company, as we said, Alphabet number one, and we look at the percentage of their portfolio that does make up these different companies, we can in fact see Alphabet here sits at number 4 with around 2% ownership, and the other class of voting rights at 1.761. So very clear to note, not only institutions very bullish on this company, but also super investors, and one that we can also reconfirm when we look at the stocks that super investors did buy the most of just over the last 2 quarters. Again, we can in fact see here Alphabet, GOOGL, 11 buys and 8 for the other class, in total 19. So just something to bring to your attention. Now, time to time, I like to remind you that Googling is for old people, not something I believe in any way, shape or form, but this is an article that was released at the back end of the year, and it was called a very large problem for the company, and something we just want to remind you of and see whether or not this is something perhaps you agree with, whether you believe that the search revenue is dying, or in fact this has all been overblown. They are growing at a double-digit rate, and one you can see them continue to do for the longer term. So the way this article goes on to talk about the company is as if it is the Titanic, and not just the Titanic in general, in the hours before it was struck by an iceberg, and therefore it says riding high, supposedly unsinkable, and about to encounter a force of nature that could make its name synonymous with a catastrophe. So why does it talk about this? What are the reasons for really overblowing the company and saying that search is about to die? They talk about their core business, so if you didn't know, and we can again just highlight, their search business of 54 billion is more than half of their total. Now, this is just for the most recent quarter, but it also holds true for the full year of 24, full year of 23, and for a number of years. Google search makes up more than half of their overall revenue. They point this down to people who are increasingly moving away from Google search. They're getting their answers from artificial intelligence, and specifically pinpointing to younger generations who use other AI generated platforms, where in fact that's ChatGPT, Grok, as well as many other different possibilities. And they see this as leading to a longer term decline in Google and their search traffic. Now, bear in mind, this article was released in November last year, and just in their most recent quarter we saw a double-digit increase, so it's very difficult as of this point in time to really justify where all of this noise is coming from. And as we would say, always do your own due diligence, never take what anyone says as fact. And they believe in 2025, or in fact the eMarketer projects, that Google's share of the US search advertising revenue will fall below 50% for the first time they started tracking it. Again, not something we have seen, so at the moment you could say a lot of this is just all talk. And as we said, the threat that they do believe is coming from platforms like OpenAI. They also talk about meta platforms and in fact search platforms like Perplexity, but it would be good to know your thoughts, whether you agree and actually you are moving away from Google search, whether in fact you're someone in the younger generation, you are using ChatGPT, OpenAI, meta platforms, or in fact Google search does make up the majority of when you want to go and look at some queries. The other thing we will point out in terms of the search engine market share worldwide, if we just look at the last 10 years, in fact March 2015 they held around 89.52% in terms of market share. If we zoom forwards to in fact just over the last few days, they pretty much hold around the same 90%. There has been no overall dent to this, and if you look at the second, third place, you are talking about Microsoft Bing that sits at 4%, something something that I probably couldn't even believe myself. Microsoft Bing isn't something that really people use, and the most searched word in Bing itself, funnily enough, is Google. So again, whether or not you believe search is dying, whether you believe younger generations are moving away, or in fact Google will just start to die off, these are all things just to take in mind. And we can see there are also other elements here like Baidu, Yandex, and I'm sure there are others that many people are aware of. But again, the data isn't just pointing that to justify that Google search is dying. And we can also notice, in fact, Google have Gemini Pro, which they are soon to release, and it does show to have some very strong performances. One thing that's always great to see with new models that come out, whether it's Grok, whether it's DeepSeek, there are always improvements being made, and we can see what looks like to be Gemini 2.5 Pro being a very strong contender for one of the best at the moment. Again, these things do change and quite rapidly. Now, just taking a look at some of their underlying metrics. First one, free cash flow payout. As always on the channel, we refer to free cash flow over earnings, which is susceptible to manipulation by management through accounting. We want below 60%. Bear in mind they only recently started to pay a dividend, but it sits around the 13 to 14%, so we would anticipate nice double-digit increases to their dividend moving forwards. And then we get to their free cash flow, where ideally we want to see consistent growth over the longer term. We get some very large increases, 1.21 10 years ago, 5.91 today, and anticipated to grow again over the next 12 months. Always good to see. And then sales growth. What's very fascinating to note about this company, whilst we want to see a minimum of 3 to 7%, 3 to 4 just to keep up in line with inflation, 9 of the last 10 years they have in fact increased their top line by double digit, other than 2023 at 9%. In fact, most recent annual accounts, 2024, showed an increase of their revenue of 14%. And on top of that, what they also have been doing lately is returning excess cash to investor pockets. That is effectively through share buybacks, reducing it from 13.9 billion 2015 to now 12.4, and I wouldn't be surprised to see them announce another large share buyback program. We just saw in 2024 around 70 billion, and management, if they do believe the company is now excessively undervalued, may start to aggressively buy back more shares. And we can also see over the last 10 years they have grown their revenue more than 4 times. Then we get to ROIC, one of our favorite metrics, 10% or more. Give us faith management are able to effectively allocate their capital. And we'll just bring you back to this graph here where we did see their anticipation of 75 billion to be spent on AI, and we did refer at that point to their ROIC being very attractive. And we can note not only above 10% but increasing, sitting at 32 in 2024. So it does give us hope that they will really be able to turn around a lot of these acquisitions, a lot of this spending on artificial intelligence into maximum value for shareholders. Also, operating margin and free cash flow margin looking very strong. We see it above the minimum 12%. Signs of efficiencies as well, going from 26% 10 years ago to 33% on a trailing 12 month. Remember, high quality companies, 2 identifiers that we would typically say. 1, increasing revenue, and the second one, increasing margins, both of which we note for Alphabet. And free cash flow margin well above 5%. We would call this a free cash flow machine, 21% just on a trailing 12 month. Then we get to the final one here, the net debt to EBITDA. EBITDA referring to the earnings before interest, tax, depreciation, amortization. We want below 3 for here, as we can see. In fact, the numbers you note below, or we should say lack of, are the number of years it would take the company to pay off all of their debt net of cash on hand. This correlates to balance sheet strength and dividend safety, basically telling us for Alphabet it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. A very, very strong balance sheet. Now, in terms of their growth, whilst they do get a C+, year on year, revenue is up 14%. Over the next 12 months, anticipated 12, well above the sector median at low single digit, and that is why we said it does deserve the premium to the sector. However, we do note a little bit lower than their 5-year at 18 and 15% respectively. However, they're anticipated to grow their EPS 16% over the next 3 to 5 years, above the sector at 12, and not too far off their 5-year at 17.9. In terms of profitability, it does come at an A+. Gross margin 58%, above the sector at 52%, above their own 5-year at 56%. Bottom line, 29%, again above the sector at 4%, well above their own 5-year at 24%. And we can also see cash generated from operations, not only one of the largest in the Mag 7, but at 125 billion, significantly above their 5-year average of 88 billion, and well above the sector at 332 million. We'll also point out, over the last year, as highlighted, they have been very poor, up only 3%. In fact, whilst we do have some others, if you do want to compare that to Meta, it's up 19%. massive outperformance. Over the last 5 years, it does turn to look very strong, 171. In fact, Meta quite a way higher at 249. And over the last 10 years, pretty much the same to be said, up there with Meta as the two best performing, 473, but Meta quite a large outperformance in comparison at 611. Important to remember though, past performance is not an indicator of the future, and also always good to compare it to the S&P, as ultimately if you're picking individual stocks, you do want to outperform. Otherwise, what's the point of all the stress, all the headaches? You may as well just invest in the S&P, put it in an ETF, for example, like Vo, that does just track that. In terms of Google then, up 3% over the last year, S&P up 6%, so a little bit more in terms of outperformance. Over the last 5 years, however, the conclusion is different. Alphabet outperforming 171, S&P 112, and in fact the same to be said over the last 10, 473, the S&P 175. Question is, can they continue to outperform the S&P? Let me know your thoughts. Maybe you believe they can, or in fact you believe this is the start of their downfall. Now, a lot of people do like Jim Cramer, what he does in terms of these stocks he advises, but there are also others who actually believe you should do the opposite. It is interesting to note his view on this, as it is a company that he has held in his own portfolio. And when he talks about Alphabet, he says there is a chart that shows ChatGPT's weekly active users, which is sitting at 400 million. That is up from the 300 million in December, and that young people, remember something we just covered earlier, are increasingly choosing AI models over Google search. However, worth noting that Melius analysts have pointed out that essentially in a recent blog, Google is saying their search handles around 5 trillion annual queries. That is not a joke, that is a significant large amount, but on top of that, OpenAI in comparison is much less, and at the moment there is no real competitor to Google search when we do look purely at the numbers. However, we can in fact see Jim Cramer did sell some Apple shares just late last year, something we covered not too long ago. He believes AI models are going to eat into Google's search share, and even if we haven't seen that just at the moment, he does ultimately believe in the longer term this will hurt their advertising business, and he's looking to continue to trim his position, potentially selling it in half, or in fact getting rid of it altogether. That is just something we wanted to bring, as we know a lot of people do like to follow analysts, whether it's Tom Lee or in fact Jim Cramer. Now, one thing that's kind of gone under the radar after being released at the beginning of December is that Google brought out Willow, which is essentially their state-of-the-art quantum chip. Now, at the moment, no one really knows what is the user case for this, how will it be implemented, and where are the consumers going to come from, but it is something that could really be another income stream over the next few years, but it is another potential income stream. Now, their own executives do say this tech is around 5 years out from a real breakout, not something that they are going to be looking at in terms of income stream at the moment, but again, just an additional layer to where Google is moving. And if you do believe that Google search is dead, well, management aren't just sitting around. As we can see, quantum could be the next area. Google also has this other income stream sitting around 400 million. Now, it is typically referred to as other bets, and in that bracket, one of those is actually Waymo, the robo-taxi. I'm sure a lot of people are familiar with it, but they are launching in Washington, D.C. in 2026, something that continues only to increase in the geographical locations, not just in the US, but also we have heard that they are also moving to Tokyo, and at the moment it does operate in San Francisco, LA, Silicon Valley and Phoenix, and also driving in Austin and Atlanta through their partnership with Uber. It's also worth noting that their revenue has only been increasing over the longer term, and we are seeing no slowdown in terms of the growth. 75 billion, as we highlighted in 2015, 350 billion just in the most recent annual accounts. But what we want to highlight here is their bottom line net income. What is the story that it does tell us? Does it follow their top line? And the answer is yes, for the large part. In fact, it's gone from 16 billion in 2015 to now sitting at 100 billion in net income. And we do believe that is a record for any company. Alphabet has broken the 100 billion net income barrier, and that is a massive increase from just over the last 10 years, and who knows where it will be 10 years from now. And finally, we want to show you the health of the company, their total cash versus total debt, which has been fairly inconsistent. It was sitting at 72 billion in 2015, and now it sits at 96 billion. But remember, one number in the balance sheet will not tell us anything. It's not going to give anything away, which is why we do always compare it to their total debt numerically and directionally. And we can in fact see, whilst it has been increasing over the last 10 years from 8 billion in 2015 to now 28 in the latest quarter, their cash is far superior, and as we highlighted, it wouldn't even take them one day to pay off all of their debt net of cash on hand. Now, before we jump into our valuation model, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also gain access to severely undervalued stocks for the month of March. Lots of information for each one, including the upside that Wall Street themselves see. We will be dropping April's copy over the next few days, so make sure you are subscribed. And on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So as we said, click below, you can sign up and read these straight away. And for everyone who is already subscribed, in Monday's version of the newsletter, you will receive a free spreadsheet running through Dividend Kings, lots of information about them, the under or over valuation, how much upside we do believe, and a lot of other pointers that we do believe are very useful. Now, jumping into our own valuation for Alphabet, we get to $226, derived from the DCF model, where we have the free cash flow year on year, including their most recent annual accounts, free cash flow of $73 billion. And the average growth is 20% on a year-on-year over the last 10. Moving forwards, we've gone 12%, although bear in mind we have a low, medium and high. Numbers here are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others. But at the 12% point and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, intrinsically 226, indicating 47% upside. Now, full transparency, we'll show you for those that believe that is way too high, at 10%, 197, indicating 28% upside, and for those that believe that is way too low, in fact, 14%, 259, indicating 68% upside. Now look, we're not done there, because we do like to take this through with a margin of safety, where we execute on this at 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Now, if you believe that in today's episode, a buy at $203, then we keep going till it's near the current trading price. And in fact, what we can see today, not a 35% MOS, but for Alphabet, based on a 12% growth rate, you're getting at least 30% margin of safety. Wall Street now saying this is one for some serious consideration in the portfolio. They see this at $220 over the next year, indicating 43% upside. As always though, give us your thoughts. Is this now too cheap to ignore? Is it a buy, hold or sell? But we also want to reflect this for those that believe 12% is too high at the 10% level. Based on an intrinsic value of $197, what is the margin of safety that is applicable today? And as we will come to show you, you are still getting a very large MOS. In fact, not at 25%, but you're getting at least 20%, and Wall Street's price target does remain untouched, 43% upside. And give us your thoughts. Do you believe, in fact, that even at the 10% low growth rate, this is now looking like a considerable serious opportunity, or it's a hold? Or in fact, let us know if you believe it's a sell and why it doesn't fit your overall portfolio. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon, where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.